Okay, today the course is Intro Managerial Accounting, Chapter 4, Cost Volume Profit Relationship. Now, what we learned so far? We learned so far that there's for different purposes, there are different costs. For the reporting purposes, we divided costs on the product cost and period cost. Product cost, we saw that the product costs including direct material, direct labor, manufacturing overhead. We already discussed that direct material, direct labor is prime cost. That's how we label it, prime cost. And then we label direct labor, manufacturing overhead, conversion cost. The prime cost comes from the Latin word prime, which is first. Direct material, direct labor comes first in the picture. Then we need the conversion cost, which is direct labor manufacturing overhead, to convert the raw material into the finished goods. That's where we have the product cost. And product cost, we have direct material, direct labor, manufacturing overhead. Then we have, for the financial reporting purposes, we have those period costs, which are directly expense once we have it. Then we saw how the costs behave, and costs behave as a variable and fixed. Now, the variable cost behave per unit and in total. Variable cost in total always changes with the relationship to the sales or volume. So every time when we have activity, that's going to change the variable cost in total, but variable cost per unit always going to stay the same. So what we have to understand is the variable cost per unit is always stable, but variable cost in total changes with the level of activity. Now we have a fixed cost. Fixed cost is the opposite. Fixed cost on the total stays the same, but per unit always goes down. Once we increase the level of activity, utilization increasing, so the variable costs tend to lower. The fixed cost per unit tends to going down. That's for the cost behavior. For the how we are assigning the cost to the object, we have direct and indirect cost. And for decision making, we have a different type. We're going to see that in chapter 12. So today we're going to focus on this cost volume profit relationship or analysis. And for that reason, we need the way the costs behave. The cost volume profit analysis is a powerful tool for the managers, which managers will be you. And you can use it to understand the relationship between the cost, the volume, and the profit organization. And we're going to focus on the interaction of the 5 elements, which consist this interrelation: price of the product, variable cost per product, volume, which drives the price, which will drive the sales and the variable cost, total fixed cost, and what's going to happen if we have the mix of the products. Before we continue with the slides, again, we're going to go over quickly over, or maybe not that quickly, over the Excel spreadsheet. And on the Excel spreadsheet, we're going to come to the point to remind ourselves what kind of income statements we have. Since we have two types of users, two main type of group of users inside the company and outside of the company, for the different people, we have a different type of reporting. For the outsiders of the company, we're using the traditional income statement format. Which starts with sales. Then we have cost of goods sold. Then we have the gross margin. Then we're going to have the operating expenses. And once we deduct from the gross margin operating expenses, we're going to come home with the operating income. The only thing that left is to put some labels here, to put some numbers, and to make it nice. So the sales minus cost of goods sold is going to give us a gross margin. Gross margin minus the operating expenses is going to give us operating income. And the operating income is going to be our final result here. So let's say the sales, let's use some simple example, 10,000, let's say, so 10 sales. Let's put some numbers here and make it like this. So 10,000 is our sales cost of goods sold. Let's go with 4,000 is our cost of goods sold. So the gross margin in this case will be 10 minus 4. It's going to be 6. And operating expenses, let's put like another 4,000. So operating income will be the gross margin minus the operating expenses, 2,000. Now that's traditional format income statement, which we're going to send to our external users, which are the lenders, creditors, and other users which are interested in the company, the income statement, and how much the company generates. That's great, but for the management purposes, we need different statements, different format of the statement. This is different classification for the cost, more specifically, which is going to help us to understand the cost. So now, before we do that, I want to leave some space here. So what we're going to do, we're going to pull out this cost of goods sold, and we're going to pull out the operating expenses. Now, cost of goods sold in this case are 4,000, and operating expenses another 4,000. Now, what we're going to do with those two costs, so we're going to identify and we're going to monitor the cost, and we're going to see how they behave. Based on the behavior, they can behave either as a variable cost, either as a fixed cost. And then exactly the same costs, we're going to allocate. Again, the total is only $8,000. Those costs, based on that behavior, we're going to create a new format of income statement, which is not going to be traditional anymore. That's traditional when we have cost of goods sold. On the new one, we're going to call it contribution format income statement. What will be different? The different will be the presentation for the cost. Now, the interesting thing is sales never going to change. Since the period already is over, sales going to stay the same. Operating income is going to stay the same. I cannot change the operating income. The period already passed. But what I'm going to do now is cost of goods sold will disappear, and that's going to be replaced with the variable cost. Gross margin is going to disappear. That's going to become a contribution margin. Operating expense is going to disappear. That will become a fixed cost. And that will be my presentation per contribution income statement format. So the sales are 10. Now let's see how much we can get from the variable cost. Let's say the variable cost is 6,000. That gives us contribution margin of 4,000. Fixed cost in this case should be 2,000. And then operating income is going to be 4 minus 2. It's going to be 2,000. Again, the only thing that we're doing is we're pulling out the cost of goods sold operating expenses, identifying how they behave. And based on their behavior, we split them the variable cost and fixed cost, plug it back in this statement, and running the calculation. Bottom on the top, the starting point is the same. And since we're using exactly the same amount of cost, the bottom part will be exactly the same. But now we have two types of income statements. One is traditional format income statement, and the other one is contribution format income statement. Again, traditional format statement will be used by the outsiders for the company, where the contribution format will be used by the company, by the management of the company. Why are they going to use it? So now let's see how we can use this contribution format income statements for our purposes or for the decision making. First thing, I'm going to flip this one and going to create a new worksheet. In this worksheet, now I need only the first part. Yeah, the contribution margin. Now let's go with something simple in the beginning. Let's pretend that we have this contribution format. We have the sales, but it's not the income statement yet. We want to see what's the sales price for 1 unit. Let's go per unit. if we're selling only one unit. So let's say if we're selling only one unit, let's say our sales price per unit $100. Variable cost for that unit is $60. So contribution margin is $40. And then we have a fixed cost, which is paid for the company. Let's say the fixed cost is $4,000. And then obviously, if we're selling only one product, obviously what's going to happen? Obviously, we're going to lose some money. How much exactly we're going to lose? How much exactly will be our loss we're selling one product? That will be my contribution margin minus the fixed cost. This is only and only if I sell only one single product. Now, why do we need this? Because the single product is the one that's going to determine how much contribution every single product is going to give to your company. Now, on the previous calculation on this contribution income statement, what formula we can come up with? We can easily come up with this formula that operating income in this case is always equal to what? Sales minus variable cost and minus fixed cost. So if in our example here, how are we going to get operating income? Operating income again is equal to sales minus the variable cost minus the fixed cost. And this is when we sell one product. Now let's go a little bit further and find out what's the ratio as a percentage. Now, if you have to express everything as a percentage, sales as a percentage always going to be 100%. Sales divided by sales is going to be 1 as a percentage, always going to be 100. Now, the question is, what's the variable cost as a percentage of sales? We can get the variable cost divided by sales, and we're going to see how much is that percentage. In our case, is 60%. That's pretty straightforward. And if we want to see how much my contribution margin, if I sell one product, my contribution margin per product, in this case, will be 100 minus 60, or 40 divided by sales, or contribution margin divided by sales is going to be 40%. So far, so good. Now let's see if we have to sell two products. What's going to happen if we sell two products? If I decide to sell two products, obviously I want to run the same calculation. Now the sales price per unit is not going to change. The variable cost per unit is not going to change. Total fixed cost also not going to change. Then what's going to change? Total sales going to change. If I sell two products, then I'm going to have $100 times 2. That will be my sales. Variable cost will be variable cost for one unit times the 2 units that I'm selling, 120. Then my contribution margin is going to be $80. Fixed cost are fixed cost. Operating income, if there's no operating income because I'm still losing money. But as you can see, there's a change in the operating income. Now let's change that change and see how much is our change in the operating income. Now, on my change between the first scenario when I'm selling only one product and when I'm selling two products, if we have to examine that change, we can easily come up with the conclusion that that change is exactly for the amount of $40. Now, the question is, where that change came from? Why there's a change? So if we have to see the change is this amount minus that amount, and our change is $40. Now the question is, why is $40? Why exactly is $40? Because I'm selling two products. And why? Because contribution margin per single product is $40. So every additional product that I'm selling, the contribution margin of that product is going to flow to my operating income. Let's see if that actually is true. Let's sell 3 products and see what's going to happen. What I'm going to do, I'm going to grab this one, I'm going to move it here. And see now if I'm selling 3 products, what will be the change between 3 and 2 products? So if I sell only 3 products, my price per unit is going to be $3 times, let's move that formula, equal to 3 times $100. So my sales will be $300. My variable cost will be 3 times $60. So my contribution margin is 120. Fixed cost stays the same, they're not going to change. But let's check what is my change in operating income now by selling 1 additional unit. Well, it's going to be exactly the same. It's going to be 380 minus 140, another $40. So every time when I'm selling, so now we can clearly make the conclusion that every time when we're selling 1 additional unit, the contribution margin of that unit simply comes to my operating income. So if I want to start generating operating income at some point, what do I have to do? First is to get my contribution margin equal to the fixed cost. That's going to save me from not losing money. Yes, I'm not going to make money, but at least I'm not going to lose money. And after I've passed the point of the fixed cost, then I'm going to start generating operating income. So I have to increase this amount to go all the way to $4,000 by having in mind that every time when I'm selling 1 unit, $100 will be my sales, $60 will be my variable cost, and $40 will be my contribution margin. Now, in a way that helps me because I always know that every unit that I'm selling, I'm getting $40. So if I sell 100 units, I know how much I'm going to get. If I'm getting $40 for single units, if I sell 10 units, I'm going to get $400. If I get 100 units, I'm going to get $4,000. Now we can easily make that conclusion. Now let's check the percentages. What's happened with the percentage? If I'm selling 1 unit, my sales are 100%, variable cost 60, contribution margin 40. If I'm selling 2 units, my ratio is exactly the same. Now, if I'm selling, let's go and sell more units. What if I sell now 3 units? What's happened with my ratios? Well, my ratios is still the same, right? I'm still contributing. The sales are still 100%. Variable costs are still 60%. Contribution margin is still 40%. Why is that? Because the only thing that drives sales and variable costs is the number of units. We're not changing the sales and variable costs. We're not changing the proportion of our variable cost compared to the sale. We're not changing the proportion contribution margin compared to sales. We're just adding new numbers. So we're just changing the activity. So in that case, if I know that every unit that I'm selling is going to give me $100, every unit that I'm selling is going to give me variable cost of $60, and every unit that I'm selling is going to give me contribution margin of $40. If I sell 150 units, can I calculate right away contribution margin? Well, how hard will be? That will be 150 units times $40. And my contribution, if I sell 150 units, will only be $6,000. Why? Because every unit that I'm selling gave me $40. That's one thing. The other thing is, if I know my contribution margin is 40%, if my total sales are equal to $100,000, can you tell me how much will be my contribution margin? Now let's think about it. How hard will be that? If my sales are $100,000, I know that only 40% of my sales belongs to contribution margin. So if I get 40% of the 100,000, that should be 40,000. 40,000 coming directly to my contribution margin. Because the other 60,000 or 60% go for the variable cost. Now, knowing that, now we can start some calculation. Once we open our company, what do we want? Once we open our company, let's say this is original data, but I erased those one now. This is my original data per unit and unit only. At this point, I can easily conclude if I sell one unit, I'm losing money. The question is, how many units I need to sell in order not to lose money? I mean, not to make money, but not to lose money. That will be the break-even point. Now, for the break-even point is when the operating income is equal to 0. That's the break-even. Now, let's do some calculation. We already saw that if I sell 2 units, if I increase my sales with 2 units, my sales going to double. Not because I'm increasing the sales price, but because I'm selling one additional unit. So my sales instead of 100 is going to be $200. My variable cost also is going to double. And my contribution margin is going to double. So for that reason, my sales that I'm generating always going to be my sales, always going to be equal to the number of the units that I'm selling times sales price per unit. Then what will be my variable cost? My variable cost will be same thing. It's going to be number of the units that I'm selling time variable cost per unit. I already know that. What else I know? I know that in this formula, if I want to go to the break-even, no, not like that. Apologies for that. I want to copy it and paste it. This. I know from this formula that the only way I to go to the break-even is my contribution margin to be equal to the fixed cost. Right? So, in other words, from this formula, operating income equal to the sales minus variable cost minus fixed cost. But from this formula, we can see that sales minus the variable cost is equal to contribution margin. So in that case, my operating income should be equal to contribution margin minus the fixed cost. But now from this formula, I can see if I want my operating income to be equal to 0, then my contribution margin that I'm generating has to be equal to the fixed cost. And that's the only way I to be on the break-even point. There's no other way. Once my contribution margin cover my fixed cost, then I'm on break-even. And that's what we're going to build now. Now, what we're trying to find out is, once you're on the break-even, how many units I need to sell, and how much should be my total sales. So let's go first with the units to sell. Again, we are at the point that we want contribution margin to be equal to the fixed cost. But now we know that sales is equal number of units times sales per unit. Variable cost is equal number of units times variable cost per unit. So for that logic, contribution margin, since sales minus the variable contribution margin should be equal to the number of units time, since sales minus the variable sales price per unit minus variable cost per unit is going to give you contribution margin per unit, then in this formula, it's going to be contribution margin per unit. And if I substitute in this formula, what's going to happen? I'm going to have a number of units that I need to sell time contribution margin per unit, and it has to be equal to the fixed cost. And that's the only way I to be on the break-even. So from this formula, can I find the number of units that I need to sell? Oh, the only thing I have to flip the contribution margin per unit on the other side. So what will be that? The number of units that I need to sell should be equal to the fixed cost divided by contribution margin per unit. Okay, we have a formula now, which is going to bring us to break even, or we're going to make the contribution margin to be equal to the fixed cost. Now let's see if this formula actually is going to work. What I'm going to do, I'm going to copy the scenarios and I'm going to flip it here. So in our scenario, what we have, let's delete this one. In our scenario, what we have fixed costs which are equal to $4,000. And I have on the single product, my sales price is $100. My variable cost is $60. And my contribution margin is $40 per unit. So that helps me a little bit, right? If I have to use the formula, let's copy the formula and flip it here. If I have to use this formula, what do I have to do? Very simple. Substitute in the formula what I know, what I don't know. I want to find out the number of units that I need to sell, and that should be equal to fixed cost, which is 4,000 in my case, time, or in this case, sorry, divided by the contribution margin per unit, which contribution margin per unit is $40. So the number of units that I need to sell should be equal to 4,000 divided by 40 should be equal to 100 units. Now let's see if that's going to check. If I'm selling here 100 units, what's going to happen? My sales are going to be $10,000. My variable cost will be $6,000. My contribution margin $4,000, which is enough to cover my fixed costs. My operating income is going to be zero. Okay, great. That means this formula actually works. Now the question is, how can I use this formula? For what purpose I can use this formula? Well, the application of this formula is everywhere in real life. For example, if you're renting apartment, let's say you're renting apartment, and you're working. Let's say the amount that you paid $25 per hour. We're gonna eliminate all the deductions that they take from your $25. Let's pretend you're getting the $25 strictly into your pocket. The next thing that we're gonna check is how much your rent. Let's pretend that you're renting one bedroom and you're paying $2,000. So let's increase this number here, sales price per unit. Let's pretend that you get paid $30 per hour. And $2,000 is your rent. Now the question is, how many hours you need to work in order to cover your rent expense? Now the fixed cost in this case will be your rent. Sales price, not going to be saved, that will be your wage per hour. So let's run the formula and see what's going to happen. Number of units, or number of hours in this case, that you need to work should be equal to the fixed cost, which is your rent expense, divided by contribution margin per unit, which is directly your wage. So the number of hours that you need to work is going to be equal to $2,000 divided by $30 contribution margin. In other words, the hours that you need to work to cover your rent is going to be simply equal to this one divided by 1. Or you need to work 66.6 hours. Now let's pretend that your working day is 7.5 hours per day. So in other words, you have to work this one divided by 7.5 hours. You need to work almost 9 days, working days, to cover your rent expense. That will be days, and that will be hours. So let's see if this actually is true. If I actually work 66.6 hours, you're going to generate sales exactly $2,000, which is going to be enough to cover your rent expense. So what's going to happen if you work 1 hour more? Now let's see what's going to happen if you work one additional hour only. So how are we going to get this calculation? Obviously, this one's going to be that will be disappear, that will disappear, that will calculation. These 2 hours going to stay, that the other one is calculation. So in this case, you're working equal to this many hours plus 1. Again, price per unit or per hour is $30. Fixed cost is fixed cost. So if you work one additional hours, now you're going to have $30. You're going to cover your fixed cost, but you're going to have $30 available for spending now for everything else rather than rent. So what that means, the contribution margin for that additional hours, which in this case is directly $30, the one which we pay, is go directly to your pocket. Now that's one way to look at the formula. Let's see another way to look at this formula. The other way to look at this formula will be, I'm going to flip it here. If, now watch the scenario now. If I need to travel and use Translink, and if I live in the two zones and I'm paying monthly, plus I'm getting the monthly plus. So the question is, how many trips I need to make per month in order to justify the fixed cost that I'm paying? So what we're gonna do, what we're gonna get? First, we're gonna get the trips, cost per trip. And if you're using the single pass, if you're going with the single ticket or that you have to buy for two zones, then let's say that's cost you $4.20, $25. Now the cost gonna go up. Today I just saw that the cost going up on July 1st. So if you wonder what to do with the extra cash that left you for this month, don't worry, Translink is gonna take it. Don't worry about it. They are very good at this. So July 1st and the next increase is going to be January. So it's always like that. Every time when the people start wondering, oh, how should they spend my money? Translink comes and say, don't worry, I'll take the money. It's always like that. Welcome to Vancouver. And so cost per trip is, let's say the cost per trip is $4.20. Now the monthly pass will be your fixed cost now. That will be, let's say the monthly pass is $150. Now the question is, how many trips I need to make in order this $150 to be covered? So the trip per month, again, the fixed cost in our case, it's not, that's now, we're going to go to this calculation. I can now use this calculation here, but I just have to modify a little bit the terminology. Now the number of the trips that I need to make is going to be equal to 150 divided by $4.20 that they have today. Or in other words, the number of trips that they need to make is around 32 trips. If I make those 33 trips, this one is irrelevant now. If I get those 36 trips, I'm justifying the fixed cost for the monthly pass. If you make one more trip, then your saving will be $4. That extra trip for you will be free. So what you have to do is very simple. Once you might buy a monthly pass, at the end of the month, check how many trips you're making per month for that month. You have on the Compass card, once you buy the monthly, you can go back and see how many times you use the Compass card. And if you use the Compass card 36 times, you justifying the cost for the monthly pass. If you're using the Compass or if you're using the SkyTrain less than 36, then you're losing money. That's another application of the break-even analysis for number of units. Now let's see what's going to happen if we have to do the same thing, but now for the total sales. Because don't forget, we have two scenarios to cover. One was for number of units of sale. The other one is for total sales. Now for the total sales, before I continue with the total sales, I'm going to delete all this information because this one is now, it's not needed in this part. Let's go and come up with the formula for the total sales. Again, my starting point is going to be my contribution margin should be equal to my fixed cost. Now listen carefully here, and I want you to think, and I want you to tell me this. Yes, the spreadsheet is going to be provided to you, of course. Now, if I do this trick, contribution margin times 1 equal to the fixed cost. Did I change the formula? What do you think? We all agree that if I do time 1, that doesn't change the formula. It's important for me to agree on this. Everybody agree with this? Everybody have no problem with that? Yes or no? Okay. Can I say then that 1 is equal to sales divided by sales? Well, if that is true, then can I do this? Contribution margin times sales divided by sales equal to the fixed cost. Did I change the formula? But now I can do some tricks. What will be the tricks? The trick will be contribution margin divided by sales times sales has to be equal to fixed cost. Can I do that? But hold on a second now. Let's go and check what was the contribution margin ratio. How are we going to get contribution margin ratio? Contribution margin divided by sales, correct? So here I have contribution margin divided by sales. And contribution margin divided by sales is giving me exactly my contribution margin ratio, correct? And now suddenly I have completely new formula, which is contribution margin ratio times sales. It has to be equal to the fixed cost. What was my objective here? To check how much are my sales. Now, can I get the formula for the sales? Well, obviously I can now. What will be that? My sales should be equal to fixed cost divided by contribution margin ratio. And now you're going to say, yeah, that sounds great. But can we test it? Well, let's test it in our scenario here. So this is my formula. Sales has to be equal to fixed cost divided by contribution margin. My fixed cost is equal to $4,000. My contribution margin ratio is equal to 40%. So my sales should be equal to 4,000 divided by 40%, or $10,000. So let's forget this calculation and let's plug the numbers but ourselves. If my sales are $100,000, variable cost is zero. If my sales are $10,000, and I know that my contribution margin is 40% of that sales, then my contribution margin is going to be equal to 10,000 times 40%, or $4,000, which is exactly enough to cover my operating expenses. So now, do I know how much my sales? Yes, 100%. If I know my contribution margin is 40, how much left for the variable cost? Obviously, 60%. How much will be my variable cost? I can easily calculate it. So now we have two powerful formulas. Let's put it side by side. For the break even, I have formula for the number of units that I need to sell, and I have formula for the total sales that I need to achieve in order to be on the break even. Now let's explore the formulas for a second and see which one is common and which one is similar. Both formulas having different objectives. One chasing number of units, the other one chasing total sales. But what's interesting is both formulas have the same denominator. Both formula has fixed costs as a denominator. The other common thing is both formulas have contribution margin in some extent as a denominator. Now, what you have to have in mind is that if you're chasing the number of the units that you need to sell, obviously you're going to need contribution margin per unit. So number of units, contribution margin per unit. If you chase the total sales, then you need contribution margin ratio. What we found with the contribution margin ratio. Contribution margin ratio doesn't change. Regardless how many products you're selling, contribution margin always going to stay the same, 40%. What else doesn't change? Well, contribution margin per unit doesn't change. Also, there's one more thing that doesn't change. Fixed cost doesn't change. So fixed cost, which is your denominator, stays the same. Contribution margin per unit stays the same. Contribution margin ratio always stays the same. So now I can easily calculate the number of units that I need to sell and the total sales that I need to achieve in order to cover my fixed cost. Now, once we start running our business, we're gonna find out that this is the things that we're gonna need to achieve to come to the break-even point. Number of units and total sales. And we already come up with the idea that in our scenario here, in order to come up with the break-even, either we have to sell 100 units, either we need to achieve $10,000 sales. Once we do that, then Well, this one will be simple calculation between the sales minus variable cost. Then we're going to come to the break-even. But being the break-even is boring, isn't it? So let's see, if we want to achieve some target income, what shall we do? Now remember, at the break-even, our operating income is equal to 0. So now we want to change that operating not to be 0, but to be something else. So give me how much target income you want to achieve. Give me some number between 10,000 and 50,000. 50,000, okay, 50,000. How we want to achieve target income of 50,000. Now the question is, how many units we need to sell in order to achieve what we want, which is 50,000 income. Because staying on the zero operating income, that's not fun. So what we need to do is very simple. We're going to use the same formula, but now with a slight modification. And the modification will be if you want. So this formula works only and only when the operating income is 0. Now, if you want operating income, what we have to do, we have to add it to our fixed cost. If I add what I want to achieve to my fixed cost, or this 50,000 I added to my fixed cost, and run the calculation, I'm going to get the number of units that I need to sell in order to achieve 50,000. Now I can say, okay, but we don't believe you. Let's try this one. Okay, let's run the calculation. Fixed cost is equal to $4,000. Target income we already said that we want to be $50,000. Let's move this one right here. And also, we know that my contribution margin per unit is equal to $40. That's what we know. Now let's run the formula and see what's going to happen. The number of units should be equal to, let me grab this for number of units somewhere. No, I don't have it. So the number of units should be equal to not 3, obviously. Gonna be number equal to bracket 4,000, which is my fixed cost, plus the 50,000 that I want to achieve, divided by contribution margin per unit. In other words, if I sell 1,350 units, my operating income is going to be $50,000. Let's see if this one's going to check. I'm going to flip it right here. And let's run the calculation. So if I sell 1,350 units, let's see what will be my calculation. My total sales is going to be 1,350 times $100 or 135,000. My variable cost is going to be 1,350 units times $60, or it's going to be $81,000. My contribution margin is going to be $54,000, which will be enough to cover the fixed cost and give me operating income of $50,000. So now we know how to budget and how to predict what's going to happen if we want, what we have to do if we want to get a $50,000 operating income. We have to sell 1,350 units when the selling price per unit is $100, variable cost is $60, and our fixed cost is $4,000 in, uh, in total. What you can do with this, you can do another calculation here now. If you have your living expense, and if you now the living expense and the fixed cost, you can add it all together and see how much is your cost to live. Then you're gonna go to your wage, and if you want to save $50,000 per year, you have to run the calculation and see how many hours you need to work. Then you have to find, do I have that many available hours per year? And if you have, go for it. So from this, the other way that you can look at it is now you're getting here contribution margin, but let's say you can interpret these numbers like this. If you work 1,350 hours per year, if you're making $100 per hour, your living expenses are $81,000 plus or $85,000 if you combine those together. Then you'll be able to generate a $50,000 savings. And that's only and only if you don't pay taxes. That's another way to interpret those numbers. Now that's for the number of units. Let's see if how is the calculation if we need to run the same thing, but now for the total sales. Now give me a new target income now. What will be the new target income that you want me to achieve? Now give me any number, doesn't matter. 100,000. Okay, let's go with the $100,000. Now new target income is $100,000. Okay, so what we have to do? Get this formula, total sales, and see what we know, what we don't know. Now, in this formula, in order to get the target income, don't forget, in this scenario, operating income is 0. So what we have to do? We have to add what we want into the fixed cost or nominator. So what's going to be here? Plus $100,000. And run the formula again. And that's how we're going to find out how much we need our sales to be. So again, let's see what we know. We know the fixed cost is equal to $4,000. The target income that I want to achieve is $100,000. And my contribution margin ratio is equal to 40%. That's what I know. Once I run the formula, my total sales should be equal to bracket fixed costs plus 100,000 close to bracket divided by 40%, or 260,000. If I generate here sales of $260,000, where I know that my contribution margin is only 40% of those $260,000, So 360 times 40% is going to give me the contribution margin available. That will be enough to cover the fixed cost, which is $4,000, and give me the operating income, which I want. Now, the other application that we can find from these calculations, I'm going to flip it right here. Once we find, let's pretend that now this is our, I'm going to erase all this thing. Now I don't need this one anymore. 1,300. Let's say we're selling at this point. This is the break-even, where the break-even is. And this is, let's say, this is my actual. In the actual, I'm selling 1,500 units. So the other application of all those break-even analysis and formulas is to find out how much is my margin of safety. In other words, I have to compare the actual to break-even. So where are my sales on the actual level? My sales at actual level are 150,000. Where are my sales on break-even? Sales on break-even are $10,000. What's the difference? Well, my difference is 150 minus 10,000. So I'm $140,000 above break-even. So margin of safety in sales is $140,000. Can I express it as a percentage? Why not? How I can express it as a percentage? Well, 140 divided by 150, I'm on my margin of safety right now is 93%. What that tells me? That tells me that if my current sales drop with $10,000, I don't have to worry about it. Or if my current sales drop with 10%, I don't have to worry about it. Now, can I express margin of safety as a number of units? Well, who's going to stop me? I just have to change the formula a little bit. And what they have to do? Units sold at actual level and units sold at break-even. And I'm going to find margin of safety and number of units. At actual level, I'm selling 1,500 units. On the break-even, I need to sell only 100. So I'm 1,400 units above. My margin of safety magically is exactly the same. Again, the sales here is only by the level of activity, so the percentage always going to be the same. So again, if my sales drop with 100 units, do I have to worry about it? No. If my sales drop with 1,000 units, do I have to worry about it? Not yet. You're still above the break-even. Yeah, you may not generate the same amount of operating income, but you're still above the break-even. And that brings us to the last concept for today, which I have to give you. And the last concept for today is the cost structure of the different type of companies. Now, as we can see, the cost can be either variable, either fixed. Now, that brings us to the point, what kind of company we may see. I'm going to use this contribution margin, and I'm going to flip it right here. We may see different companies. We may see a company which is heavily exposed to the variable cost, and we can see a company which is heavily exposed on the fixed cost. In order to see that one, I have to come up with some example, which I'm going to come up in a second. So imagine we have these two companies. One again is exposed on the variable cost, the other one is exposed to the fixed cost. Let's mark it different color. Fixed cost is blue, variable cost is green. So what that means, let's go with the sales 500,000. That's my sales. Now this company will be heavily exposed on the variable cost. Both company, however, is going to end up with exactly the same income, 5,000. That's 50, that's 5,000. And 5,000 here. So what that means? That means that this company fixed costs here will be, since it's variable, heavily exposed on the variable cost, the variable fixed cost will going to be only $1,000. And now I have to generate 494, 123. My variable cost is $494,000. With the other company, still the same sales, 500,000, but that company is heavily exposed on the fixed cost. So the variable cost is very minimum. Let's go with 2,000. Generating ginormous contribution margin, $498. But the fixed cost is the one that makes the difference. So the fixed cost is $193,000. And operating income is $5,000. How we can see that this ginormous difference between one company and the other? When we express the contribution margin as a percentage, then we'll be able to see it and understand what exactly happening. Let's go with the percentages and see where is the percentage here. Sales are always 100%, no questions about it. Sales always going to be equal to sales divided by sales, which is 1. As a percentage, 1 is always 100%. Now the variable cost here will be as a percentage of sales, 99%. Contribution margin per unit that you're generating here, this is for 1 unit, or any units. For the contribution margin, obviously, is going to be 6 divided by 100,000, or 1%. In this company, completely different scenario. What that means? That means that, again, the sales will be I have to space it here as a formulas and express it as a percentage. And then we're going to have this one, 2 divided by 500,000. Doesn't even catching the percentage here. Let's give that a little bit higher now, 5,000. So as you can see here, the variable cost is only 1% of the sales. The rest is contribution margin. Now, what that means? That means that the company which generating that ginormous contribution margin, one additional unit of sales is going to give us ginormous profit. Where in this company, if you're generating one additional unit of sales, the profit is not going to be that much. Now, this company will be very dependable on the sales of the products. And if the sales would drop with one unit, they're going to have a huge loss. Where this company is not going to be that heavily exposed to the not selling one additional product. So that means their loss will be limited and they can live without selling one additional product. The question is, which kind of company is going to have this kind of cost structure and which kind of company is going to have this cost structure? The variable cost company which rely very exposed very too much on the variable cost rather than the fixed cost, it can be a grocery store. The grocery store, when they're selling, let's say, superstore selling watermelons now, the contribution margin per watermelon will be very, very, very small. So what that means? That means today, if I don't sell 500 watermelons, that's not going to hit my operating income. Why? Because I'm relying on sales on the watermelon to sell at least 200,000 watermelons per day. So if my sales drop with 500 watermelons, I'm not going to feel it. These companies, imagine I'm Chanel and I'm selling bags. Where do I have to place my stores? In the premium location, which the fixed cost is high. But since my variable cost per bag is very small, the contribution margin that I'm generating from one single sale is enormous. So I don't need to sell 10,000 bags per month in order to pay my rent. But if I don't sell one additional bag, my loss of the contribution margin will be high. The last thing that left is the mix of the products, but I'm going to leave it at the time when we go back to the slides. So that's in general cost volume profit analysis. Now we're going to see a different perspective through the slides when I start covering the slides. Now let's go now. Cost volume profit analysis. Again, the perspective through the slides. First thing that we're going to see is this company, which is contribution margin statement is given to you. And what we're going to do, we're going to copy this one and let's flip it on the Excel spreadsheet and see what we can do with this. Let me share my screen again. Try to get the information now. Let's flip it like this. Okay, I have my information here. Let's quickly close this information and see how that's going to look in our Excel spreadsheet. We're going to have, once we're selling, this company is selling 500 bikes. And once they're selling 500 bikes, their sales, total sales are equal to 250,000. Their variable cost is equal to 150,000. The contribution margin for this company is 100,000. or 250 minus the 150, the operating expenses, or fixed cost in this case, is equal to 80,000, and the operating income is equal to this one minus that one. I have to add one more zero, and then we got it. All right, put the lines, make it the right format here, and then we understand reality. Let's put the numbers here, dollar sign on the first one, dollar sign on the last one, and we have the perfect contribution margin income statement when we're selling 500 bikes. Excellent, right? So now, this is when I sell 500 bikes. What's going to happen? What will be my information here if I sell only one bike? Can I calculate that one? Obviously, how hard would it be, right? If I know the total when I'm selling 500 bikes, how hard would it be to get if I sell only one bike? Well, obviously, will be 250 divided by 500 is going to give me sales price per one bike. And 150 divided by 500 is going to give me the variable cost per one bike. Fixed cost not going to change. Fixed cost is always going to be fixed cost. So that will be my cost structure if I'm selling only one bike. So for one bike, this is the cost structure. So let's see as a percentage. Where am I as a percentage? Obviously, sales divided by sales is always going to be 100%. We already established that one. Now the question is, where is my variable cost? Variable cost divided by sales is 60%. So that looks like the scenario that we had in our previous Excel spreadsheet. So that gives us contribution margin of only 40%. And 40% we have here. Let's see what will be our percentages if we're selling one unit. Well, magically, it's going to be exactly the same. Why? Because the only thing that drives the sales and the variable cost is the number of the bikes that we're selling. We're keeping the sales price the same, variable cost the same. Obviously, contribution margin is going to be the same. So the percentage, they're never going to change. Okay, that's great. So let's go back to the slides and see how the slides continue on this point. So if we have to go per unit level, we can easily calculate, we already calculated that per unit, sales price per unit is $500, variable cost is 300, contribution margin is 200. As ratios, sales are always 100%. Variable cost expresses sales either per unit, either in total, always going to be the same, or 60%. Contribution margin, either per unit, either in total, always going to be the same, 40%. Fixed costs are fixed cost. They're not changing. And that's how we're calculating the percentages. Either we're going to use the total, either you're going to use the per unit. That ratio is never going to change. So what that means? That means that this company, in order to be in break-even, every single month, they have to generate contribution margin at least equal to the fixed cost. For break-even, fixed cost. To generate profit more than the fixed cost. Let's pretend they're at the break-even. What's going to happen if they sell one additional bike? The contribution of that additional bike is going to flow directly to the operating income. Why? Because every time when you're selling one additional bike, you're getting $200. Once you cover the fixed cost, every additional bike after that's going to give you another $200 and $200 and $200. So once we know that, that every additional bikes give us $200, and we know that for 400 we cover the fixed cost, can I easily calculate how much will be my income if I'm selling 30 bikes above the break-even? Well, how hard would it be? 30 bikes times the contribution margin per bike is going to be $6,000. So my increase in my operating income is going to be $6,000. Why? Because I already covered the fixed cost. That's the, in order to make a graph and express cost volume profit analysis in as a graph, we need to have certain points. When we connect them, we can put the lines. So let's say one of the point is when we're selling 300 units, the next point is when I'm selling 400 units, and the next point is when I sell 500 units. Again, sales price stays the same, 500. Variable cost stays the same, 300. Contribution margin stays the same, 200. Fixed cost and fixed cost. Having this in mind, on the hour graph, we're going to put that number of units are on our horizontal, and the sales indoors will be our vertical. So I know my fixed costs are $80,000, and I know as soon as I start the sales, variable cost start coming. So I have to go and rush and to sell 400 units as soon as possible, because once I sell 400 bikes, I'm at break even. After that, I'm generating profit. So first objective of every company obviously will be to reach that break-even point. Now, how are we going to calculate the contribution margin ratio? We already calculated. Either we're going to use the total sales, either we're going to use the per unit. Once we calculate the contribution margin, total contribution margin divided by the total sales, we're going to come up with the percentage 40%. Now the question is, what that means to us? What the 40% means to us? The 40% simply means that for every dollars of sales, we're going to get only and only 40 cents. How can you use this for your personal life? If you're getting a paycheck, what I want you to do is take a look at the paycheck. There's a gross amount and there's a net amount. Gross amount obviously will be 100%. Then check what the net amount is. Express the net amount as a percentage of the gross amount. And you're going to see on every dollar that you earn, how much you get. Obviously, it will be less than $1, but the question is, how much exactly is? How many cents of every dollar that you work, you actually goes to your pocket? And that's how you can express that as a percentage. So you can use for the contribution margin ratio, you can also use the, let me see which screen I'm sharing right now. Yes, I'm sharing the right screen. You can use the contribution margin per unit and sales price per unit, which is going to give you exactly the same percentage. Again, the percentage never going to change until we keep the same cost structure. $500 sales price, $300 variable cost, $200 contribution margin. So once we know how much we're getting for every dollars of sale, let's see what's going to happen if we increase the sale with $50,000. Or 50,000, our sales goes up. But also the variable cost is going to go down. Also the contribution margin is going to go up. But not the same ratio. So what's going to happen? Actually, the ratio is going to stay the same, but not the same magnitude. So what's going to happen now? Only on the $50,000 increase, only 40% is going to flow to my contribution margin. And since I cover my fixed costs, that's going to go directly to my operating income. How much is 40% of the $50,000? 20,000. If my sales increase with, let's say, 100,000, only 40% is going to flow to my operating income, or that will be $40,000 increase in operating income. Now let's practice this in one question with this coffee shop. I'm going to copy this question and let's go quickly to the Excel spreadsheet. And that's my question here. And let's make it a little bit bigger. So what do we know? We know my sales price per coffee is 1.49. I also know that my variable cost is 0.36. That's going to help me to calculate my contribution margin, which contribution margin is going to be equal to sales price minus variable cost. So now let's expand those cells a little bit so we can see the entire cost structure. And what else I know? I know that my fixed cost is $1,300. I also know, just happen to know that my at this level, I'm selling 2,100 cups. So this is for 1 cup. I'm selling only cups sold. That will be a 1 here only. And let's go with the scenario that we're selling 2,100 cups. Now, if we're selling 2,100 cups, what's going to happen? I want to insert one here. I'm going to grab this calculation here. Now, before I grab this, I have to move this one a little bit up. Get those one and flip it right here. So once I'm selling one, that's what's happened. But in this scenario, I'm selling 2,100. So let's calculate how much is our operating income on this level. Operating income is going to be contribution margin minus the fixed cost. So if we're selling 2,100 cups, my sales is going to be that much. My variable cost is going to be that much. My contribution margin will be that much. I'm going to cover the fixed cost, and my operating income $1,073. That's where I am currently. Now the question is, how much is my contribution margin ratio? Well, how hard will be? Sales divided by sales going to give you the percentage of the sales, which is 100%. Then we're going to express the variable cost as a percentage of sales. And then we're going to get the contribution margin as a percentage of sales. Since they wanted to treat decimals after the 0, let's expand a little bit. And that will be more than 1 for the percentage. Why is only 1 decimal? So let's calculate what's going to happen if we flip those percentages here. And magically, we're supposed to get exactly the same percentage, which we're getting it. So regardless which you're using, is it per unit, is it in total, the contribution margin ratio always going to stay the same. Now let's go back to the slides and continue with this question. So what we're going to do, the contribution margin is equal to 0.758 or 75.8% is our contribution margin. So which are the key formulas here? The profit, always going to, or operating income, always going to be equal to the number of the units, contribution margin per unit, minus the fixed cost. Contribution margin, always going to be sales minus the variable cost, where the contribution margin per unit is going to be number of units of sales minus the variable cost per unit. Sorry, that will be sales per unit versus variable cost per unit. Contribution margin ratio, you can get it either total contribution margin divided by total sales or contribution margin per unit divided by sales price per unit. Variable fixed ratio will be the variable cost divided by sales. And in this formula, CM is contribution margin, Q is the quantity of the products sold. So again, the variable expense ratio always going to be variable expense or variable cost divided by sales. Contribution margin ratio will be either 100% minus the variable expense ratio, either 1 minus the variable expense ratio as a number if you use it, not as a percentage. Let's bring the question. What is the profit impact of this company if increase unit sales from 500 to 540 by increasing the monthly advertising budget by $10,000? Now let's see what's going to happen with this company if they do that. Let me see what the original scenario of this company. I believe this is the one. Okay, let's flip it here. And let's create a new worksheet with the same information. So the question is, again, what is the profit that this company can increase? What will the profit impact if this company increase the unit sales from 500 to 540 by increasing the monthly advertising budget to $10,000? So now, there are two ways to do this. One way is obviously get it per unit and then flip it to the current situation. So let's stay here with the units first, and that will be equal to this one, and then we're going to be equal to that one, and then going to be calculation, and boom, boom, boom. And then if we're selling, let's get this scenario here where we're selling 500 bikes. Oops, that's going to be, sorry, it's going to be right here, it has to be here. So if I'm selling 500 bikes, then what's going to happen is those will be 500 here. And let's get the calculation of 500 times this number. And then I'm going to have a 500 times 300. And then contribution margin is going to be this one minus that one. Oops. So if something doesn't work for me, I know why it doesn't work, but I'm going to fix it just a second. And I get 80,000 is my fixed cost, and that's going to be equal to that. Okay, so I have when I'm selling 500,000, 500 bikes. Now the question is, if I increase that sales with 40 units only, what's going to, and increase the fixed cost with 10,000, what's going to happen? So there are two ways to approach this question. Run the calculation and see what's going to happen. That will be one way. So I'm going to copy this and I'm going to flip it a little bit further. And let's run the calculation to see what's going to happen if we selling 540 bikes, but increasing the
Could you
fixed
please
cost.
share the screen?
Yes, I forgot to share the screen. Well, thank you. Yes, can I share the screen? So let's go back here. What I did. Basically, I haven't done anything yet. I literally haven't done anything yet. What I flip is I flip this per one bike on the one side and 500 bikes on the other side, and did a new calculation here in order to get the format that I need. That's what I did. So you haven't missed anything yet because there was no calculation at this point. So there are two ways to approach this one. Let's push this one right a little bit, and then yes, this cells like this. There are two ways to approach this question. One way is to run the entire calculation. The other way is to see only the differences. Let's run the entire calculation. The entire calculation is, let's go here, bike sold. Now I'm selling 540 bikes. And here will be again, bike sold, 500. If I sell 540 bikes, what's going to happen? My sales going to be $270,000. No questions about it. My sales as a percentage obviously is going to be 100%. Let's copy this one and flip it right here. What's going to happen with the variable cost? Variable cost is going to be 300 times 540. And my contribution margin is going to be this one minus that one. Now, what's happened with my fixed cost? My fixed cost increased with 10,000. So instead of 18, now they're 80 plus 10,000. So then 90,000. Where is my operating income now? My operating income is 18,000. So when I compare to where I was, this is where I was, this is where I am right now after the changes. Is it profitable for me to do these changes? Obviously, it's not. Why? Because I'm losing $2,000. That's why I want to do it. But as you can see, this way, doing this way is too heavy. You have to run the new financial statements. You have to calculate everything. It's too much. Is there a short way? Yes, there is a short way. What's the short way? Right now, I'm selling 500 bikes. I'm not changing the cost structure for the bike. So I'm moving from 500 bikes, 540 bikes, from 500, I'm moving to 540 bikes. What's the difference? The difference is 40 bikes. I'm selling 40 bikes more, clearly. What's my contribution margin per bike? Contribution margin per bike, I already know it is $200. That means if I sell those 40 bikes, my total contribution margin that I'm going to generate, it's going to be equal to $8,000. But my fixed cost, which I just increase, this is the total contribution margin. Let's put it this one, increase. But now I have increase in my fixed cost, which is $10,000, negative $10,000. So what's going to happen with my operating income? Obviously, the result will be not preferable. Or in other words, you're going to lose $2,000. That will be shortcut approach. Again, one approach is to run the financial statements. The other one is just to see what happened. What is the increase? Use the contribution margin, come up with the increase that you're going to get, deduct the fixed cost, see what's happened. Let's move now to the slides again. Not that's on the slides, obviously. That will be the slides here. So what's happened again? In this case, one way is to run the financial statements and to see the difference. So as we can see, the operating income went down with $2,000. So basically, that's not preferable for us. The other option is the shortcut approach, which is increasing the contribution margin 40 units, additional $200, $8,000. Increase the advertising expenses 10,000. Decrease in operating income 2,000. Now let's try another scenario. The other scenario will be, what is the profit impact now if we use the high quality raw material? That means the variable cost now going to go up. But that's going to increase the unit sales from 500 to 580. So we have increase in sales with 80 units. Second thing is variable cost goes up. That means contribution margin is going to go down. Instead of 200 now contribution margin, we're going to have 190. So when we run the calculation for the entire picture, we're going to see that if currently we're making 20,000, if we do this, if we increase the variable cost with $10 and decrease the contribution margin with $10, the increase of the bikes that we're selling with 80 bikes more is enough to generate additional $10,200 for us. So basically, we should go for it. Next one. What is the profit impact if the company cut the selling price with $20? So instead of 500, you're going down to 480. Increase the advertising budget to 15 by 15,000 instead of 80,000. Now we are 95,000. And the sales increase from 500 to 650. So as you can see, now we start playing. What if this happened? What if this happened? What's this happened? What will be the effect on the operating income? So if you run the income statement, we're going to see, yes, the sales increasing, but not the same way that before because the sales price went down a little bit. Contribution margin obviously is going to be affected. It's going to go down. Per unit is going to go down, but in overall it's going to increase because we have 150 additional bikes that we're selling. Fixed cost went up with 15, but we're still generating 2,000 more income compared with where we are with 500 bikes. So this scenario, it's worked for us. Next scenario. Now, what will be the profit impact for this company if pay $15 sales commission per bike instead of paying flat salary 6,000 per month and increase the unit sales from 500 to 575 bikes? So what we're doing now, we're reducing the fixed cost with 6,000, but we're adding variable cost $15 and increasing the bikes with 75. The other thing that we're doing here is very simple. We make our salespeople incentive to the amount of bikes that they're selling. Currently, they're just getting $6,000 and they don't even care how much they're selling. But if they go on the commission and making $15 for every bike that they're selling, now they have an incentive. Now let's check something here. Very quickly, let's check something. I'm going to share my screen. I'm not going to forget this time to share my screen. or at least try to not to forget. So if we come here to our scenario, and let's grab this one, the original one, and I'm gonna flip this one here. In the current situation, now I can use this situation here. That would be nothing. This should be nothing. This should be nothing as well. Yeah, let's put some numbers. Here we need here 500 and here we need 300. That's for the bikes. Once I'm selling those bikes, I'm getting those sales. No questions about it. And this scenario, I don't need it at this point. Or maybe we can use it, but after we do the calculation. So let's see what's going to happen here. What will be the profit impact if we pay $15 commission per bike sold instead of paying salesperson flat salary $6,000? Let's think about it for a second. If these people selling 500 bikes and they get $15 per bike, how much in total they're going to get? They're going to get $7,500. Can you see this? By only selling 500 bikes. Now, currently, they're making for 500 bikes that they're currently making, they're making 6,000. So which one is better for them? To stay on the salary when they're selling 500 or to move to the commission? Obviously, moving to commission is going to give them $1,500 right away. Now, since they see that, now this incentive is to sell more bikes, and they're going to 575 bikes. Times $15, now they can generate 8,625. That's increasing their salary with 2,625. They're getting 2,625 more than what they currently making per month. Now let's run the numbers and see where the company will be. Currently, we're under 20,000. If we implement those changes, we're going to sell 575 bikes. Now my sales going to go to 500 times 575. Now my variable cost is going to change now. My variable cost is going to be 300 plus the $15 commission that I'm going to give them, plus $15 times the number of units that they're selling. Now, as you can see, my contribution margin now is 106. But my fixed cost, now the fixed cost, original fixed cost, is not going to stay $80,000 anymore. It's going to go down to with 6,000 because now I'm not paying them salary anymore. They're getting variable. So what's happened now? Their income increased with 2,625, and my income increased with 12,375. So their win make me more money actually. So the fact that they're generating more income brings more income to me. This is the win-win situation with both parties here. This is how you can make your salespeople motivated to earn more money and at the same time to bring more profit to you. So let's see the slides. So if this happens, what's going to happen is the scenario is again the decrease in the 6,000 and increase in the commission, moving them to commission, obviously help you to increase your operating income. The other one will be if the racing has opportunity now to sell 150 bikes to wholesaler without disturbing the sales and all the fixed expenses. So neither the sales are distorted, neither the fixed expenses are increased. What will be the quoted to the wholesaler if we want to increase the monthly profit by 3,000? So let's move back to the Excel spreadsheet and let's take a look and think about it. I'm going to grab the original scenario, which will be this one. Yeah. And I'm going to pose the question here. So what's happening in this case? I am where I am. My fixed cost not going to be affected. My sales price per unit for the other customers going to stay the same. Somebody comes and say, can you sell me 150 bikes? And I want, instead of 20,000, to make it 23,000. So I want $3,000 only. In other words, I want $20 profit per bike. So if I generate $20 per bike, that's going to guarantee me 3,000. Currently, I'm selling the bike. So again, currently I'm selling the bike for 500. My variable cost is 300. And currently, I'm making my contribution margin, as we can see, is $200. But I don't want that. I want to make only $20. I want my contribution margin to be only $20. I know my variable cost is 300. So how much should be my sales price? Obviously, should be 320. So if my sales price is 320, then that's going to guarantee me the contribution margin of 20. And when I sell 350 bikes, it's going to give me the profit that I want. That's one way to approach the case. The other way to approach the case is, okay, I want, since the fixed cost is not part of the game, I want contribution margin of $3,000. But if I sell 150 bikes with 300 per bike, my variable cost will be equal to 150 times 300. My variable cost will going to be $45,000. So how much should be my sales? My total sales should be 48,000, or my variable cost plus the profit contribution margin that I want, 48,000. How much will be per bike? 150 here, and it's going to be exactly the same amount, 48 divided by 150. I need to sell the bike for $320. And that's the only way I had to get my $3,000, which I want. So as you can see, this type of questions you can approach it different ways. Per unit or in total, always going to bring you to the same result. Let's go to the slides and see how the slides continue. Again, you can go per bike. I want from $3,000 from 150 bikes. So I want $20 per bike. Variable cost is 300. So I need to sell it for 320. Other way, From the 150 bikes, I need $3,000. My variable cost will be 45. So I need to sell them for 48 to cover the cost 45 and get the $3,000. For the break-even analysis, we have two methods. One is the equation method, the other one is formula method. I'm going to show you both. You can use whichever it's easy for you. There's no recipe here. Whatever it's easy for you, that's what you should use. So the equation method is profit is equal to sales minus the variable expenses minus the fixed expenses. Or the sales is equal to the variable expenses plus the fixed expenses plus the profit. At break-even point, we want the profit to be equal to 0. That's how we get the break-even point. So once we have our information and we know the sales price per unit, and variable cost per unit, and contribution margin per unit, we know the fixed cost, and we know the ratios, then it's easy to apply to the formula. Sales, we're generating the sales, 250, because we're selling 500 bikes times 500 per bike. So 500 per bike times quantity that I'm selling is equal to the 300, which is the variable cost, times the number of bike that I'm selling, plus the 80,000, and I want break even to be profit to be 0. Once I solve the problem for the Q, or the number of units, I'm going to get 400 bikes. If I want to use this one for the total sales, equation method to get the total sales, then total sales will be, I don't know how much will be, but I know that the variable expenses is 60% of the sales. And the fixed cost is 80,000. Once I solve the problem for the X, I'm going to get that 80,000 divided by 0.4 should give me the 200,000. So 200,000 should be my sales. Formal method, again, is the one that I show you with the final formula, which is the fixed expense is in the both formula. You can see it unit sold and total sales. Nominator is exactly the same, fixed expenses. Denominator looks similar. Contribution margin in both is involved, but for the number of units, contribution margin per unit. For the total sales, contribution margin ratio. And when we express, we can get exactly the same. So let's do with our question here with the coffee. I'm going to flip back to the Excel spreadsheet. I believe this was the coffee. And for once we have the coffee, let's flip here the second question. And I'm going to get this structure here, that the calculation that we already calculated. I'm going to put it right here to have it available. So once we have this, we're chasing how many coffees, the number of the coffees that we need to sell is equal to how much to be on the break-even. Well, the number of the coffees will be equal to the fixed cost divided by contribution margin per unit. We know the fixed cost, we know the contribution margin per unit, so the number of the coffees should be equal to 1,300 divided by 1.13. So once we sell 1,050 cups of coffee, we should be at the break-even. Let's see if that's actually is going to check. If I replace this number here with that much, yes, I'm at break-even. Let's go back to our slides. $1,150 coffees. So what will be the break-even in sales in dollars? If we have to get the sales in dollars again, let's go back to the Excel spreadsheet. If we have how to calculate the sales, then we're going to get our cost structure here. Move it down a little bit and run the new calculation. So now the total sales equal to how much? Well, that will be fixed costs. Now the total sales should be equal to the fixed cost divided by contribution margin, but now ratio. Or the total sales, in this case, it should be equal to fixed cost divided by contribution margin ratio, or should be 1,715 in this case. We're going to round it up. So if that's my sales now, that's not number of units in this case. So if my sales are 1,715, what's going to happen? I need, or I can use this number, the exact number, and I know my contribution margin is this number, so I have to generate the contribution margin, which is equal to sales time the percentage that I calculated. That's going to give me exactly 1,300, and I'm on the break even. So if you have those type of questions, this Excel spreadsheet, you can use it. Let's go back to the slides. And that's how you're calculating it. So the target profit, again, the target profit, we have to add whatever we want to achieve into the fixed cost. Once we add it to the fixed cost and run the calculation, we can see how many units we need to sell, or that's this is on the equation method. This is from the formal method. On the formal method, you are in the target income to your nominator, and you're running the formula and getting the number of bikes. For the coffee shop, let's go to the coffee shop and see how the coffee shop's going to work. If I want to achieve certain amount of sales on the coffee shop, what do I have to do? I'm going to flip it a little bit down now. Here. And how many cups we need to have sold if we want to attain the target profit of 2,500 per month. So I'm going to grab this calculation here. Actually, not this one. I need the cups. So let's go with the cups sold. And go down right here. So what I have to do, I have to add the profit that I want to my fixed cost plus $2,500. And when I run the calculation plus $2,500, I'm going to get that the numbers of the coffee that I need to sell is that number of units. That should be number of units, so we have to remove this one. 2,000 fixed cost, contribution margin per unit. 2,500. That's not exactly what I'm trying to get here. Why it doesn't work? 2,500 fixed cost. Yes, I know what is it, because I'm missing the bracket. Once I put the bracket, it's gonna work. Be careful with the formulas. Always check the formulas if you're using the Excel spreadsheet, because if you don't miss the bracket, it's gonna give you a completely different calculation. So as you can see, how one small mistake on the calculation using the Excel can change the numbers. So in this case, we need to sell 3,363 coffees in order to achieve the operating income that we want, $2,500. Let's go back to slides and get our calculation here. Again, we're going to add the 2,500 into the nominator or fixed cost. Run the calculation, see the number of cups. Margin of safety. Margin of safety again is where you are compared to the break-even. Margin of safety is a common question which is given. Why? Because indirectly you have to calculate the break-even point. You won't be able to get the margin of safety if you don't know the break-even. But you won't be able to get the break-even if you don't know how to calculate the break-even. So the margin of safety is common question that comes again because indirectly ask you to calculate the break-even point. So once we know the break-even point for the bikes is 400 units, and we know that currently we're selling 500 units, and we know that our sales currently is at 2,500, but on the break-even is 200,000 only, we can easily see that our margin of safety is $50,000. As a percentage, that will be 20%. If we want to calculate it as a number of bikes, we can get the total sales above divided by the number by the sales price per unit. We're going to get $100. Or we just go hundreds. Simply see that I'm selling 100 bikes more. As a percentage, always going to be the same. 100 divided by 500 is going to be 20% again. Now let's see in our coffee shop what's happening with the coffee shop. Where is our margin of safety? I'm going to share my screen again. Now we're going to run different calculation for our coffee shop because at this point we know the break even and we want to see where we are. Let's paste this one. So break-even point, let's find the break-even point. Where was the break-even point? Is what we're chasing here, number of units? Yes, cups. As a number of cups, where we are here. Let's copy this. And let's go to our calculation here. So on the break-even, why the formatting doesn't work? That doesn't make sense. Let me try again. Yeah, I know the format. Why the formatting doesn't work? Just give me a second. And once I come here to this point, I'm just gonna paste it like this, and now it's gonna work. So at break even, I know that I'm selling 1,150 cups. Currently, I'm saying 2,100. So where's my margin of safety? Margin of safety is gonna be 2,100 that I'm currently sell minus the units that I need to sell. That's going to be, if I round it up, it's going to be 950 cups above margin of safety. As a percentage, we can easily calculate it. That's going to be margin of safety as a percentage is going to be equal to 950 divided by 2,100, or my margin of safety is 45%. Let's go back to slides. So again, my margin of safety 950 cups, or as a percentage will be 45%. Cost structure and profit stability or sustainability, the way you want to call it. There's a different organization, and now we're going to the operating leverage, which is expressed by the cost structure of the company. So some companies, again, are largely exposed to the variable cost. Some companies are largely exposed on the fixed cost. Which advantages if you're on the high fixed cost? That means the contribution margin per unit is ginormous. Disadvantages, in the bad year, you're gonna lose a lot. But advantages in the good year, you're gonna make a lot. Which are the company which are using high contribution margin per unit? Obviously, the premium, all the premium product producers, Louis Vuitton, Chanel, Hermes, uh, what else? Cartier. And all those examples are the high contribution margin products. Cost is not going to be that high as a percentage. Contribution margin is ginormous. So the single sales can pay you the rent for the entire month. Hotel business is also part of this. Hotel business. Operating leverage, that's going to bring to the operating leverage. Operating leverage is simply how many times you have contribution margin in your operating income. Or that's going to be give you the how much you're exposed on sales. What's your exposure on sales? So now let's see with this company with selling the bikes. They have contribution margin at the current level when they're selling 500 bikes. The contribution margin is $100,000. Their operating income is 20. So that gives us operating leverage 5. What that means? That means if I increase the sales with 10%, my operating income is going to jump with 50%. Or increase the sales times the operating leverage. Leverage means when you have a lever, if I change on one side, what's going to happen on the other side? That's what we're chasing. So let's see if this actually check. So as you can see, my actual sales currently sales are 500. If I increase with 10%, I should be selling 550. 250,000 of my current sales. If I increase with 10%, that means 25,000. My sales going to jump with 275,000. Now let's see what's going to happen on the bottom. On the bottom, my operating income from 20 jumped to 30. That's 50% increase. $10,000, a 50% increase where I was. For only 10% increase in my sales. Now let's see where we are in our company here, where we are on the operating leverage. I'm going to copy again this, flip on the Excel spreadsheet, go with the Excel spreadsheet and show you there. This is where I am. Now for the operating leverage, what I need the original calculation that we did the very beginning, which is right here. And now once I have it, I can go all the way down right here, paste it, and now working with this one. Why do I need this? Because I need my contribution margin at the current situation. When I'm selling 2,100 units, my contribution margin is 2373. My operating income is 1073. So what I'm chasing is my operating leverage. It's going to be equal to contribution margin divided by operating income. Or simply, how many times you have the contribution margin in the operating income? In this case, my operating leverage is going to be equal to contribution margin divided by operating income, or it's going to be 2.21. What that means to me, if I increase the sales with 10%, if you have increase in sales with 10%, the increase in operating income is going to be equal to 10% times 2.21, or it's going to be 22.12%. That's what means. If increase in operating income is 20%, maybe I should put here increase in sales, let's put it here 10% and then just use the formula rather than overriding, and that's going to help me to increase 10%. It's going to be equal to 10% times 221. If increases with 20%, if I increase with 20% or 20% here, is going to be equal to 20% times 221 is always going to be increased with 44.23. If my increase is 50%, my increase in operating income is going to be 110%. So that's the application of that operating leverage. Tells you how much will the effect on the increase in sales going to give it to the operating link. Let's go back to the slides and finish those slides. So if we're using the, again, operating leverage for our company, it's going to be 2.21, and the logic is contribution margin divided by the operating income, or how many times I have contribution margin in the operating income. So if I want to increase now with 20%, obviously, operating leverage, the operating income is going to increase with 44.2%. And that's the rationality, how exactly that works. How the 20% increase in sales reflect that, give you that 40.42% increase in the operating income. Now, in difference analysis, this is interesting point in difference analysis. This is a cost profit volume analysis, which is useful to aiding decisions about the comparative profitability of the alternative products or method of production. So you have two different methods which have a different cost structure. So the analysis focuses on the cost behavior in the relationship with the changes in the actual activity. The objective here is to find the level of sales at which you are indifferent between the two options. And then you can base your decision on the expected sales level. So in the indifference analysis, what you have to do, determine the unit contribution margin times number of units of sales, plus the total fixed cost of each alternative. So you have few things. Get the contribution margin per unit times the number of units plus the total fixed cost. Then set up the equation for each alternative and solve it for the number of units. And that's going to give you indifference point. The last thing that left is the concept of the sales mix. Now, for the concept of the sales mix is when you have two different units and you're selling with both units, but we never change the proportion. The proportion of the sales doesn't change. So how can I get the break-even here? the break-even, we're not going to chase on the single product contribution margin, rather than we're going to combine the both product. We're going to calculate the contribution margin when we combine the both product on the total calculation. Fixed cost is fixed cost. We're going to come up with the total sales that we need to achieve for the break-even. After that, I'm going to go back to the original scenario. And we're going to see if I have two products, both products obviously contribute to the sales. Sales 100%. Then I'm going to see what's the percentage of each of those products which they contributed to the total sales. And once I come up with the break-even point with the total sales, and I know that the first product contributes 45% to the sales of the company and the second 55, then I'm gonna apply these percentages to the numbers that I'm getting as a break-even sales. And we're gonna come up with the how much sales I need to generate for one product and how much I need to generate for the other product. So all these things to work, we have to have few things in mind. First, selling price don't change. Next thing, variable cost per unit doesn't change. Fixed cost in total doesn't change. Means the costs are linear. First, the cost behavior is a line. Second, you can clearly divide it only on the variable and fixed. And once you divide it on the variable and fixed, you know the variable cost per unit stays the same. Fixed cost in total stays the same. Flat line. When we have the multi-products, the sales mix is constant, doesn't change. If my sales mix is 45 to 55, that's how it is. End of the story. And for the manufacturing company, if you're doing this analysis for the manufacturing company, whatever you produce, that's how much you're selling. You're not changing the inventory level. You're not building inventory. You're not decreasing the inventory. So as you can see, so many things have to happen at the same time. But again, this cost volume profit analysis is a powerful tool, which is going to give you an idea how much you need to achieve from the sales. And there's a certain uncertainty, but we're not going to go that deep. And that concludes today's chapter.